Well, good afternoon, everyone, and welcome to our third quarter Capital Markets Outlook webinar. Before we get started, I do want to highlight the Resources tab, where you can find more of our insights and a survey to share your feedback on today's event. Additionally, please ask questions using the Q&A tab, and we'll address them at the end of our prepared remarks, provided the time allows. My name is Jake Simoniak, and I'm a Senior Global Equity Strategist here at Manning & Napier. Today, I'm joined by my colleagues Jake Boak and Brad Cronister. Jake is the Managing Director of our Consumer Group on the Core Equities team, while Brad's a Senior Analyst and Portfolio Manager on our Fixed Income team. Guys, before we move on, I was hoping that each of you could basically tell us a little bit about yourself, maybe your path here at Manning & Napier and your current role, kind of before we get going. Jake, let's start with you.
Hi, everyone. I'm Jacob Boak, Managing Director of the Consumer Group. I have been with Manning & Napier for about 18 years now, the entirety of that time in research. I started out as an associate in our CapEx group, helping a team of analysts cover oil and gas, chemicals, transports, ag equipment, and fertilizers. I was there for about 2 years, maybe 3 years, before I transitioned into tech, where I spent the next 13 years sort of spearheading our investments in e-commerce, software, and fintech. And then more recently, I've taken the reins of the Consumer Group, where I lead a team of analysts responsible for investing in both the global staples and global discretionary sectors.
Great. Thanks, Jake. And Brad?
Yeah, I'm Brad Cronister. I'm a Senior Analyst and Portfolio Manager within the Fixed Income Group. I've been with Manning & Napier for about 15 years and pretty much primarily in fixed income research, focusing on global rates and foreign exchange. Currently one of 3 voting members deciding on top-down positioning for our fixed income portfolios, where we vote on duration targets, sector allocation, and yield curve management.
Great. Thanks, guys. So before we really get going, before we get into this, I'm going to do what I typically do at the outset of these conversations and sort of lay out the major topics, the major themes that we're going to touch on, kind of where we're going to go with the conversation. First, given the volatility that we've seen from U.S. equity markets, kind of what we've seen in equity markets globally, we're going to talk a good bit about those markets with a focus on the U.S. From there, we're going to move on and have a conversation about the U.S. economy, how things have evolved up to the point we're at, what we saw in the first quarter, and kind of where we could be heading from there with a specific focus on labor markets and housing. After that, we're going to have a conversation about the bond markets, again, touch on how things have evolved, where we stand in the U.S. sovereign market, maybe touch on corporates a bit. And then I think the thing that's going to be interesting and lead to the last part of the conversation is we're going to talk a bit about some of the divergences that we've seen in global bond markets to start the year. And from there, we're going to do a bit of a deeper dive on a couple of the key kind of major economic centers, ex-US, and talk about some of the opportunities that we're seeing abroad. From there, we'll wrap this up and we'll move on to questions. So, with that said, I do want to talk about equities to kick this off and kind of recap what we've seen to start the year. And I know that when I think about US equity markets this year, it's kind of a tale of 2 halves through the first 6.5 months of the year at this point. When I think about the starting point for the year, we came into the year with expectations for earnings growth and economic growth, I think high relative to what was actually happening underneath the surface of the economy. Valuations were not compelling. They weren't necessarily at extreme levels, but they weren't tremendously far off. And I think the thing that really stood out to me was that both sentiment and positioning was at an extreme. So as we started to move through the year, markets melted a bit higher, but ultimately we got to February, March, markets started to sell off. That accelerated on Liberation Day with the announcement of the tariffs, ultimately resulted in something of a clearing event where tariff policy really did a 180 and markets rallied pretty aggressively from there. So I guess with that, Jake, I'm going to turn it over to you, and maybe you could give us a little bit more detail on what it is we've seen in equities to start the year.
Yeah, sure. Thanks. It's been a pretty wild start to the year, bit of a roller coaster ride. If I sort of think back to January, we started the year and really all eyes were sort of on the transition of power taking place in Washington. Valuations at the time were fairly lofty. The S&P was sort of hitting all-time highs. And it certainly felt like there was some amount of euphoria embedded into the market. But after closing out January, everything changed pretty quickly. We had the news from DeepSeek, the Chinese AI startup, That pretty much popped the AI bubble in early February after it claimed it had achieved performance parity with other leading AI models at a fraction of the price and the power requirements. So that's all it really took to derail the Mag 7 leadership. And pretty much any company with an AI footprint saw its market capitalization drop, pretty significantly in a short period of time. So the market rolled, vol spiked, and then not long after we had to digest that debacle, the new administration began to roll out its aggressive trade policy, and more or less forced the market to endure a series of escalations and I guess de-escalations as well. Then, of course, we have the ongoing conflict between Russia and Ukraine, as well as turmoil in the Middle East between Israel and Iran. So the risk there being potential for rising energy prices and any fallout that could occur from that. Somehow, despite all that, the market sort of clawed its way back in the second half of the quarter. And as we sit here today, the S&P is fully recovered. We're up roughly 7% year to date. So it's been a bit of a whiplash type of market environment. I do think one noteworthy observation is the fact that international stocks have significantly outperformed their US counterparts. They're up closer to 19-20% year to date. Certainly the weakness in the US dollar is a contributing factor there. But I'd say that I'm pretty happy with the way the team here has transitioned the portfolios more towards international opportunities over the last 6 to 12 months. That's certainly been a performance tailwind for us and for clients. And it's confirmation to me that our bottoms-up process sort of has us fishing in the right ponds.
Yeah, and I think that's a good way to transition the conversation to what I want to talk about next. From my perspective, from the top-down perspective, it's been clear for a while that the rate of change in the US economy has been, still resilient, but heading lower. I think the opposite has potentially been true for major economic centers. And, you combine that with things like the valuation discrepancies that we saw between US equities and ex-US equities. It's not necessarily surprising that we got to that position. Before we do get to that topic, those topics, I do want to have a conversation about the US economy, though. And we've touched on the broad resiliency for quite some time now. I think the last quarter was really the one where we saw significant cracks in that. Now, Brad, I'm going to turn this over to you, but there's two things that stand out to me when I look at this chart. The first is the impact of net exports, which was obviously massive. And I think there's potentially a unique dynamic that we can get into there. The other one, though, is the not contraction, but the slowdown in personal consumption expenditures. And to me, that's noteworthy as well. So with that, I'm going to turn it over to you, and maybe you could touch on those two topics for us and whatever else it is you want to cover.
Yeah, I think if you're ever going to dismiss a headline GDP number, the first quarter of this year is definitely one to dismiss. I think, with both trade and inventory stocking ahead of expected tariffs impacting the GDP report, showed a decline of -0.5%, but net exports knocked off about 4.5 points from that headline number. And then inventories kind of counterbalance that, positively adding 2.5 points to the headline GDP number. As we go, transition through the year, likely to see those two components reverse. But still have uncertainty with trade. It continues to linger. So what we've done is we're trying to look more at final sales to domestic purchasers, which continues to show a growing economy, albeit slowing of economic activity. Looking at personal consumption, 2024 was actually a pretty good year. Personal consumption grew at about 3.5% last year. First quarter numbers showed some softness. Consumption was only up 0.5%. And it's likely that this softness is going to continue into the rest of the year. 2Q, we saw consumer sentiment weak. Post-Liberation Day, financing costs remain elevated. So unlikely to see an acceleration in spending for the remainder of the year. However, I think it's pretty clear that performance of financial markets and the wealth effect is supporting consumption. And really, unless that turns, it's difficult to be really bearish on the consumer.
Yeah, and I like that we had the opportunity to get the top-down perspective on this, and then also the bottoms-up perspective as well, Jake, given your coverage areas. So having said that, how do you see the US consumer as having held up? And I guess, how do you see things shaping up moving forward potentially?
On the U.S. consumer remains fairly resilient. The high-end consumer is relatively unscathed, which is sort of what you'd expect in this environment. You know, you've got a reinvigorated stock market at all-time highs. 401ks are looking pretty plush. Home prices are up more than 50% in the past 5 years. Bitcoin and other risk assets are ripping. And then, at least for now, unemployment remains relatively contained. So for this cohort, you know, home equity, job security, 401ks, those are all the primary factors driving sentiment. And right now, all is sort of well on that front. I will caveat this and say that we are picking up on anecdotes of some trade down happening with this group of consumers. The dollar stores, which I cover, have been pretty vocal about seeing more higher and middle income consumers trade down in their category. So maybe things are starting to turn a bit here. We'll have to wait and see. The low-end consumer is having an altogether different sort of experience. Rising prices have been a real drag in this cohort for several years now. Some recent policies out of Washington will likely have a dampening effect on the health of this cohort. So things like cuts to SNAP benefits, Medicaid, immigration reforms, all sort of weigh heavy here. But to be fair, you have potential offsetting factors like tax exemption on tips, overtime pay, and auto loan interest. Those should all be relatively stimulative to the low-end consumer. And again, the labor market looking like it's in pretty good shape, but I do worry about some cracks forming here. Real wage growth looks okay. Debt service payments are below their 50 to 40-year average. Consumer balance sheets are generally looking okay. So we don't think the households are overly extended. Subprime credit delinquencies for credit cards and autos have been improving on a year-over-year basis for the first several months of the year. So I suppose the overall message would be that the low-end consumers are, while not immune, the data suggests that they're a fairly resilient group still. They continue to spend, albeit those big discretionary outlays aren't really happening. But on the whole, I'd say spending is far more resilient than would have expected, given a lot of the macro noise.
Yeah, I appreciate that context. And I think maybe one thing I would add that's important is that for better or worse, when we talk about potential weakness from that income cohort, the reality of the situation is that we're talking about kind of a low single-digit % of the overall consumption basket as well. So there's no question that it moves the needle for companies that are exposed to that, but at an aggregate macro level, significantly less important. Now, you mentioned labor markets, and we are going to get there. There is one more thing I want to touch on before we move on, and that's fixed investment. I think it's worth talking about, A, because of the strength we've seen, and B, really because of what that, I guess, how that has been reflected in the equity market within certain, I guess, thematic trends. So Brad, if you could, maybe you could talk to us just a little bit about kind of the strength we've seen in fixed investment, and then we'll move on.
Yeah, even when you strip out the positive contribution from the inventory build in the first quarter, fixed investment was actually a huge positive for GDP, and it can really be distilled down to that kind of AI tech investment boom. Information processing equipment added a full 1 percentage point to headline real GDP numbers, which is actually larger than any peak quarter we had, which includes the tech bubble back in 99, 2000. But in terms of where we are seeing some softness is residential investment, and housing remains pretty weak. Obviously, we have affordability issues, high mortgage rates, definitely keeping residential investment subdued. So unlikely to see it turn there anytime soon.
Great, I appreciate that. And like I said, with labor, we'll certainly get there, but we do need to talk about labor first. And for anyone who's been on a couple of these with us, they've heard me say this several times now, but there's no conversation about the U.S. economy that doesn't involve the labor market, right? Consumption represents something like 70% of the U.S. economy. The labor market's key to that. So much like the broader economy, labor markets have been incredibly resilient over the course of the last several years. We've had, I guess, multiple periods where we've seen cracks start to form and things pretty quickly kind of reversed and got better. I think it's fair to say that we're in one of those, potentially at the outset of one of those periods now, where you look at some of the data that's coming out of the labor markets, and again, you're asking yourself questions, right? You're seeing these cracks start to form. So Brad, I would turn it over to you and just maybe broadly, what is it you're seeing when you look at the US labor market today?
Yeah, I think it's fairly simple that we're in a soft patch in terms of labor markets. Number of indicators that we're looking at. I think the kind of the best indicator that can tell you whether we are in a really tight or loosening labor markets is wage growth and also the quits rate. And both of those have shown some softness. Wage growth is down from upwards of 5% year on year, 18 or 24 months ago. Compared to now, we're sub 4% if you look at the Atlanta Fed wage tracker. Quits rates have actually come down too over the last 12 to 18 months. So it shows that employees are less willing to leave the jobs they have. We're seeing a little bit of a divergence here in the chart, which shows unemployment claims, initial unemployment claims compared to continuing claims. And while initial unemployment claims have remained, relatively low, continuing jobless claims have actually stayed pretty high. So people who have been fired are having a difficult time finding new jobs. So there's a bit of a hiring freeze going on. You can see that in general business indicators. Look at the ISM, both manufacturing and non-manufacturing. NFIB shows small businesses are slowing down hiring. And it's not just in more manufacturing or cyclical industries. It's broadening out into the services side. And then I guess lastly, the other softness we're seeing is higher unemployment rates for recent college graduates and people who are early in their career. I'm not sure if this is kind of early signs of the impact that artificial intelligence will have on labor markets, but it's certainly showing some loosening within labor markets. We're not seeing a cratering in hiring though. The two non-farm payroll reports post Liberation Day have actually surprised to the upside. So job creation is hanging in there. But what we're trying to kind of figure out from here is whether this soft patch is just kind of a period of low business confidence, high uncertainty before maybe animal spirits can come back and hiring can improve, or whether this soft patch is more part of the order of operations where you get softness that leads to weakness that could kind of spark this unwanted move higher in unemployment and increase recession risk. But I think that for the most part, the jury's still out on the direction of travel from here.
Yeah, it's interesting. It feels like we're at another one of those points where we're kind of staring at a fork in the road and really trying to figure out, okay, it seems like we're waiting for something to happen. We're waiting for the data to break one way or the other, but there's not overwhelming evidence that we feel really comfortable making a really strong call one way or the other. So, Jake, we just heard kind of the top-down perspective on what it is we're seeing from labor markets, kind of at a high level, what the data is showing. What is it you're seeing? Like, what are you seeing from your perspective as a bottoms-up analyst in the industries that you cover? Is there anything worrying on the labor front that's worth pointing to?
Worrying. Sure. If you're sort of asking about specific industries in my coverage area, I guess the one that would be top of mind for me is what we're seeing in the alcohol complex, which has really struggled as of late. I think there are some real demographic and secular shifts that have negatively impacted per capita consumption. And that's being felt pretty much across the board by brewers, vintners, and distillers alike. So we had Brown-Forman, whose portfolio is anchored by Jack Daniels. They announced a fairly sizable workforce reduction earlier this year. Campari Group, who is based out of Italy, but they own several brands in the US like Wild Turkey and Sky Vodka. They're cutting about 10% of their global workforce. Constellation Brands, a local company here in Rochester we all know and love. They've divested a number of mainstream wine brands, and we're hearing that layoffs have commenced. So that's an industry where I think things are pretty bleak and the outlook doesn't look much better. The other industry that might come to mind for me are the layoffs in the auto sector. Not just the manufacturers, but companies further up the supply chain as well. Hard to sort of pinpoint how much of this is temporary furloughing due to tariff uncertainty, or how much is sort of permanently going to stick due to things like slowing EV sales, and globally speaking, increased competition from Chinese EV brands like Boyd and Li Auto.
So I am going to humor myself here, and the conversation that we've been having so far has focused kind of on the cyclical dynamics and where we are in the US economy today. Brad mentioned the potential for AI to be weighing on continuing claims, especially for young people entering the workforce. I am interested in whether or not, you've seen anything that would suggest there is credence to this idea that AI really has the potential to disrupt labor markets moving forward. Are you seeing any evidence of that today?
It's early. Um, that being said, I guess what I'd say is that the AI risk to labor is probably top of mind for all investors lately. Over the past several months, we've had a number of companies talk about how far some of these AI tools have come and how they're becoming increasingly effective in areas like coding. So in mid-May, Google's chief AI scientist was speaking at a conference, and he said something to the effect that AI would reach the capability of a junior software engineer within a year. 2 weeks ago, Andy Jassy, Amazon CEO, was doing an interview with Jim Cramer, and he was basically double clicking on how AI agents are now handling a lot of the coding, the analytics and research tasks. And what struck me was he was particularly candid about how generative AI means that fewer people will be required in order to keep the lights on at Amazon going forward. And so if you sort of extrapolate out the rate at which AI is advancing, it's really not hard to imagine what might be coming down the pike in terms of more companies making headcount optimizations. Certainly in many sort of tasks that are fairly routine, but also increasingly in areas like software development where just a ton of savings can be had.
Yeah, it's super interesting. And I feel like it raises just a ton of really, I guess, interesting structural, almost societal questions that, you know, I know those are conversations we have here. They're conversations we'll have in the future. Probably not tremendously well suited for this format today, though. So maybe something to come back to in the future. We are going to move on. We are going to talk about housing now. Again, for a while now, we've talked about the resilience of the US economy, but one thing that has routinely come up throughout the course of that conversation has been the fact that over the course of the last several years, we've really seen different parts of the economy, specifically on the manufacturing, more traditionally cyclical sides of the economy, industrial exposed sides of the economy, where we've had almost rolling recessionary conditions. And I'm not entirely sure that housing fits that description, but I'm also not entirely sure that it doesn't. So Brad, I'm gonna put just a broad question to you. Could you talk to us a little bit about what you're seeing in housing today?
Yeah, just from a really high level, residential investment housing just remains weak. There's clear affordability issues. This is impacting both new builds, but also existing home sales. I think a lot of people who bought a house over the last 2 or 3 years were kind of banking on this window for refinancing, lower their monthly payment. But that's clearly not come to fruition given where yields have gone over the last 12, 18, 24 months. But I mean, inventory remains tight. House price appreciation has allowed for pretty significant equity buildup for current homeowners. The thing that remains elusive and kind of the thing that does look more recessionary is you're waiting for this large multiplier to come from new home buyers or increase in household formation, but that just remains muted because affordability is such a big issue, both from the house price level, but also from mortgage rates up near 7%.
Yeah, and I think one of the things that's really interesting and worth pointing to there, everything you said is completely correct. I think to the extent that it looks like there's something changing for the first time in a long time, you actually have existing inventories of existing homes starting to head higher. And I don't think that the combination of that alongside the affordability issues that you correctly flagged is necessarily a coincidence, right? You've got home price growth starting to slow, and in some cases actually start to go negative in certain cities, especially where the build out was huge, where you had really aggressive activity in industries like Airbnb, where suddenly that demand that you thought was going to be there might not have been. To the point you mentioned, people might have bought thinking that they could refi at lower rates, and that hasn't come through. It's going to be interesting to see how this plays out over the next several months and whether or not you really need rates to fall significantly for housing activity to pick up. Now, Jake, I mentioned this with respect to the consumer earlier, but again, we're lucky to have you here to have this discussion, kind of given your coverage area. I guess two questions for you. First, can you talk just a little bit about how stocks exposed to the housing, we'll say, industry have fared? And second, maybe you could touch just a little bit on how we're exposed to that part of the market in the portfolio today.
Sure. It's been tough sledding for housing related names. As your chart there shows, turnovers at pretty depressed levels for several years now, held down by, weak affordability. We track credit card spending by category, and you can sort of see it in that data. Categories like furniture have been decimated. Spending hasn't been in positive territory really since the COVID surge. So companies like Restoration Hardware, Wayfair, Ethan Allen, they've all really struggled in terms of top line growth. The home improvement retailers, Home Depot, Lowe's, Floor and Decor, I would say it's not getting worse, but the comps and traffic are sort of like flattish at best. And there continues to be, softness in purchases of big ticket items. I think the key debate is, when do comps bottom, and how much will they recover? It's sort of unknowable. So, we've stayed away from housing exposed retail. So our housing related exposure across the portfolios is relatively minimal, let's say.
Great. So we are going to move on, and no conversation about the economy would be complete without a discussion of inflation, kind of given where we're coming from, where we are today, and kind of what it'll mean for the Fed and rates moving forward. We've seen inflation come down significantly over the course of the last couple of years, and now we're at a point where we're significantly closer to the Fed's target rate than we have been in quite some time. Brad, if you can you walk us through how inflation has evolved over the last couple of quarters, and maybe just some of the risks that we're seeing today, both to the upside and the downside?
Yeah, I mean, we've had a good amount of normalization with prices, getting close to the 2% target that the Fed wants inflation at. A lot of this has come from deceleration in rent and housing, as well as a 10 to 20% drop in energy prices. So that can bring the headline number down, but there's also input costs that go into core that can help if energy prices remain lower. I mentioned deceleration in wage growth, bringing services prices closer to the 3.5% level from the 5% level we were at 24 months ago. And then I think kind of the disinflation we're getting from the rest of the world is kind of also helping keep prices in check, no longer at 8-9% for headline CPI. And we got to a pretty good level for inflation without a major decline in economic activity, which seemed like a difficult spot, looking back 24 months ago. From here, I think there's probably three risks to inflation bottoming and moving higher. First, certainly uncertain. There's uncertainty about the pass-through from tariffs. This morning, CPI report showed some early signs of potential pass-through. Apparel prices were up for the first time in a number of months on a month-over-month basis. Household furnishing prices were up 4% month over month. Appliances were up 1.9% month over month. So you might be beginning to see tariffs get into prices, and that could broaden out as we move forward. I personally think for the most part, it's likely a one-time adjustment in prices as opposed to this thrust higher on the index level, but it certainly remains to be seen. I think secondly, the weaker dollar is likely to put some upward pressure on prices. For the last 2 or 3 years, the stronger dollar has been a disinflationary or deflationary impact on core goods prices. But that looks to be reversing and could definitely impact import prices moving forward. And then lastly, really no sign from Washington that fiscal spending is going to slow down, and that just continues to keep prices higher than they otherwise would be. So I think in general, we've had meaningful progress, but definitely risks that we're stalling out and could see inflation move a bit higher from here. That's not to say we're going to go back to 4 or 5%, but could be bottoming and have headline inflation with a 3.5% level, in a few months.
Yeah, and I think maybe the one thing I would add to what you said as a fourth risk to the upside is just the potential for energy prices to move significantly higher, kind of both in an absolute sense and given the starting point today, right? It's not a surprise to me that if the current administration plans on using tariffs as a negotiating tactic, if they plan on continuing to spend fairly aggressively, it makes sense to me that they've been so laser focused on energy prices and keeping those low, right? Any increase in energy prices is going to lead to an increase in energy or inflation expectations, which can turn into a pretty vicious cycle pretty quick. So, Jake, maybe from your perspective, we talked about a more subdued demand environment, I guess, in certain verticals. And now we're talking about inflation. How have you seen pricing power hold up?
Yeah, let me backpedal a little bit here. In my area, discretionary staples, I can't think of a single attribute that's more important than pricing power. It's really what sort of underpins our profile strategy, right? We look for companies that have some sort of durable competitive advantage, which sets the stage for pricing power and allows that company to generate attractive returns that are far more sustainable than what the market anticipates. So for what I do, what my group does, pricing power is a major focus. I'd say with what sort of manifested in the last few years, first the inflationary pressures coming out of the COVID lockdowns, more recently the tariff noise. It's been a major eye opener in terms of seeing sort of which companies claim they have pricing power and who actually has it. And so I'd say, generally speaking, the companies that we own haven't seen that margin degradation from input cost inflation, just because they've been able to pass that through. So they've held up pretty remarkably well on that front. I think a really good example would be something like a Ferrari, which is a name that we own across several different portfolios, whose response earlier this year to the proposed tariffs was to simply increase prices pretty much across the board. And the customer, the reaction from them, quite frankly, it was like crickets. Like nobody blinked when their reservation for their $2 million Ferrari became several $100,000 more. And in fact, just having perused some of the chat boards for the Ferrari Owners Club, there were a number of posts that actually applauded the company for just coming out and saying what their plans were going to be, as opposed to sort of leaving everything up in the air. And so despite the price increase, Ferrari's production continues to be sold out, I believe now through 2027. So that's a great example of a company that sort of has unparalleled pricing power. I'd maybe throw like an Hermes into that bucket as well, another company we own. We think that the luxury goods are just a great place to be because that ultra high net worth clientele, their purchasing habits don't really change a whole heck of a lot due to reverberations in the economy. And they employ this sort of like business model built around exclusivity and scarcity of supply, which we think sort of underpins the ability to exert pricing power.
Maybe quickly before we move on, could you talk about a company that might exist at the opposite end of that spectrum?
Yeah, sure. Maybe an industry. I think of like QSR restaurants come to mind. That's an industry where the store level economics aren't particularly fantastic. It's a fairly like low margin business. It's more about volume. The switching costs are super low, right? If McDonald's raises their prices, it's not really hard for the consumer to walk across the street to a Burger King or a Wendy's. So just really no pricing power. They skew to a lower income demographic where the demand profile is far more elastic. That's an industry where we sort of shied away from historically. I think with the exception of maybe Chipotle, which we own, which sort of skews to a higher income demographic, and they have pretty good margins just due to higher customer throughput and lower overhead costs.
Great. I appreciate kind of the counter to the luxury examples too. I think that really helps frame that discussion well. So we've talked about the economy, we've talked about inflation, and I think that naturally leads to a conversation about the Fed. Brett, before we get to kind of the decision tree facing them today, maybe you could touch quickly on some of the challenges that might be unique to the current environment that are facing the Fed.
think an interesting challenge that really doesn't get talked about right now, in my view, is the disconnect between how tight the Fed sees monetary policy, with the funds rate between 4.25% and 4.5%, kind of the easy financial conditions we're seeing in the market. Most FOMC participants have talked about how they deem monetary policy as moderately restrictive. But then you go out and you look at where credit trades, look at any general financial conditions index, they remain extremely loose. Capital is abundant. I do think that probably gives them some uh, comfort in being more patient than they otherwise would be in terms of setting policy, but it definitely questions the transmission mechanism for using rates for getting monetary policy to a level that they deem appropriate for hitting both employment and inflation mandate. The obvious challenge right now is navigating the political pressure from the executive branch. I don't think it's terribly out of the norm for presidents to want or really advocate for lower interest rates, but kind of the platform daily barrage of critique is probably making Jay Powell's job much more difficult than it otherwise would be.
I like that I teed you up to talk about that first, and instead you went in a different direction and talked at length about something that's significantly more interesting, at least from my perspective. So I do want to get kind of to that latter point, though. I do want to talk about I want to talk about the decision the Fed has to make kind of from this point moving forward. How do you think that they're balancing kind of the economy and inflation today? And then maybe building on that, what are we seeing in terms of market pricing relative market pricing for rate cuts through the back half of this year into next year? And maybe where are the risks to that view?
So the pace of the hiking cycle from 2022 into 2023 kind of illustrated that the Fed was willing to take on some recession risk in order to prioritize their inflation mandate after being far too slow to reacting to price pressures back in 2021. On the other side of that, the 50 basis point cut in September of last year, coupled with two more cuts after that, showed their weariness about labor markets in the second half of last year. Now, given the pause we've had for the last 6 months or so, I think both mandates are probably relatively balanced. I do think that they'd be more willing to cut and counter any weakness that we would see in labor markets compared to letting inflation run modestly higher than where we were. But I think for the most part, we're probably pretty well balanced for where they see their mandates. I do think if there wasn't tariff uncertainty right now, the policy rate would probably be 50 to 75 basis points lower. But in terms of what we're pricing in for the market, pricing in 50 basis points of cuts for the remainder of this year, 50 to 75 basis points of cuts for 2026. And that generally seems fair given the outlook. I personally think that the market is probably mispricing the tails on both either side, whether it's them having to keep rates above 400% for longer than expected, or having to go through a prolonged cutting cycle if we get a recession. So I think the current pricing is probably mispricing the two extremes of what could happen.
Yeah, and I think that mispricing of the tails that you talked about kind of gets to the dynamic that we mentioned earlier, where it feels like we're kind of standing at the fork of the road. You can make a strong case for heading one way or the other, but it's not overwhelmingly clear kind of where we go from here. And you need a couple more cards turned over. So I guess in light of the discussion we've had about the economy, inflation, and the Fed, broadly, what has that meant for the yield environment in the US?
Yeah, so far this year we've really seen the belly of the curve. So think your 3 to 7 year maturity bucket outperforming significantly as the curve is steepened. The interesting part of the market has certainly been on the long end, but the long end hasn't necessarily sold off because long-term inflation expectations are moving higher. Inflation expectations, which is your inflation break even within the market, is the difference between the nominal yield on a treasury and the real yield on the TIPS market. Those are actually basically flat year to date, off a bit from local highs. So most of the increase has really been on the term premium, and really the uncertainty about where yields go from here. I've always kind of subscribed to the idea that fair value for the 10-year is expected nominal growth rate. And so if we assume the run rate for real growth is, around 1.5%, 2%, you add on, moderately higher inflation than we saw last cycle of, call it 2.25%, 2.5% over the long run, you actually get to a 10-year treasury, basically where we've been trading over the last few months. So I don't really think the yields are totally divorced from kind of the economic conditions right now. Within fixed income portfolios, we're modestly overweight duration. And so if valuation gets more attractive, so if we cut out, price out some more rate cuts or real yields could go a little higher, we're probably more likely to buy into some of that weakness as opposed to selling into strength.
And since you mentioned fixed income portfolios, could you maybe just touch really quickly on what you're seeing in the corporate market?
Yeah, we came into the year relatively light corporate credit risk. Notionally we had benchmark levels, but our beta or kind of our spread duration within the portfolio was below most benchmark levels. During the April sell-off, we modestly added some corporate credit, but given the rally, we've kind of looked to pare back some of those adds. The asymmetry within corporate credit is pretty unattractive. We're almost 2 standard deviations rich within corporate credit spreads. And basically what that means is if you get a 10 to 15 basis point widening in, investment grade corporate bonds, you wipe out an entire year's worth of carry. So that asymmetry doesn't really prove to be a great risk reward for us. Well, we do think you can be selective in credits, trying to maximize idiosyncratic risk across the portfolios. And where we can find improvements in quality or go higher up in the capital structure, we're looking for those swaps to kind of lower our credit beta.
Thanks. I appreciate you getting pulled off topic for a second there. We are going to take it back though, and we've talked about kind of what the environment has meant for US sovereign yields to start the year. I think, it's interesting that kind of in light of the conversation we've had, we haven't necessarily seen a tremendous change from the start of the year to now in US yields. And it's interesting that we're actually down, kind of given some of the inflationary pressures we've talked about, given some of the structural conversations that have gone out there about changes to US standing, desirability of holding US debt. That dynamic has not necessarily persisted ex-US. Can you talk to us a bit about that?
Yeah, I mean, you mentioned it, it seems like all the commentary has been about the sell-off in US Treasuries, who's going to buy US Treasury debt, given the debt deficit dynamics. But people seem completely unaware of what's going on globally. You've had a much larger sell-off. I mean, US 10-year for the first half of the year was actually down. But you've seen a significant sell-off in yields outside the US, specifically looking at Japan and Germany, and Europe in general. I think within Japan, that's probably just a normalization of monetary policy, less central bank buying. They target the long end with most of their issuance. But within Europe, I think it's a little bit more of a economic playbook scenario playing out. To me, it looks early cycle in Europe, and I think we'll talk about this in a little bit, but that's where you've seen the boost on 10-year bond yields, and it's obviously had an impact on other asset classes, and probably the reason the dollar was weaker in the first half of the year.
Yeah, and I think that's exactly where I want to go, kind of with the back third of this conversation at this point. You mentioned the potential for just a traditional economic cycle to play out in Europe. And I think one thing that's particularly interesting when you take a step back and really look around the world today, I guess when you think about the way that the global economy functioned from kind of the early 2000s and China's ascension into the WTO, really through COVID, you found yourself in a period where the global economy was pretty well synchronized, which I guess thematically, structurally, when you think about the idea of globalization deepening, capital integration deepening, it makes sense that those cycles would be fairly well coupled. But again, when you take an even bigger step back and you kind of look at the history of the world, that's not history of the world, the modern history of finance, of economics, like that's not necessarily how things have tended to function. And I wonder if we're not in a more similar period, at least for now, where global economies are far less synchronized than they have been. And I think that Europe is a really good example of that, potentially China as well, and we'll get there. But Brad, maybe you could talk to us a little bit about just kind of why it is you think that we might be early cycle in Europe right now, what it is you're seeing that kind of confirms that view.
Yeah, I think it's pretty clear that we're seeing early cycle dynamics playing out. The ECB has cut policy rate by over 200 basis points over the last 12 months. We've seen significant fiscal stimulus announcements in Germany, both on military spend, but also on the infrastructure side. Um, Labor markets aren't so tight that you get an improvement in growth. You're not going to necessarily see a spike in inflation or wage growth. So I think, and you're starting to see credit expand. So I think, being exposed to some early cycle in Europe makes sense. The way that we've expressed that within our portfolios is trying to be long euros and then shorting bonds against UK gilts, where we think there's a clear divergence between the path for those economies.
Jake, I'm going to pull you back into the conversation in just one second here, but before I do, I want to dig a little bit deeper, Brad, if we can, on Germany. I think it's a really interesting example and highlights how US policy could potentially be catalyzing some changes to things that we really haven't seen in quite some time. So can you talk maybe just really briefly, kind of outline what it is we've seen in Germany, and then maybe give me your opinion on whether or not you think what we've seen there is repeatable in other European countries?
Yeah, the massive fiscal spend is significant in my view. I don't necessarily think that the military spend is going to be as impactful unless you own European defense companies. The economic multiplier for most military spend is actually quite low. But I think the infrastructure spend is significant. And if you couple that with an improvement in the regulatory framework, I think that could be significant for the German economy. 500 billion euros over the next 12 years is a large number. But I don't know how repeatable that will be throughout the rest of the Europe. As someone whose early career was kind of defined by the European sovereign debt crisis and the pig countries, LTROs, TLTROs, all the acronyms that are stuck in my head. I'm very hesitant to think that Spain or Italy or Portugal would be able to come out with a fiscal spend of 2.5% GDP over the next 10 years and the market not revolt at some point.
Yeah, and Jake, I appreciate you being patient and dealing with us talking macro for a while here. I do want to pull you back in. Two questions for you. Maybe you could talk to us a little bit about what you're seeing specifically on the European consumption side of things, and then more broadly, can you tell us how we've worked or how you've worked to increase our European exposure and the sorts of themes that we're exposed to there in the portfolios?
Sure. Bit of a mixed bag, I'd say, on Europe consumer. There were a handful of European retailers that called out pretty weak trends in the early part of the second quarter. But I'd caution against reading too much into that, just given the sample size was small and they were apparel retailers, so we know that they're exposed to weather trends. But based on some of the survey data that we look at, I sort of get the sense that any angst from European consumers is driven more by like a tenuous political situation rather than the health of their respective economies. I'd say that there are pockets of discretionary spend which are holding up pretty well. Things like travel would be top of mind there. And industries like apparel, which may be showing less robust demand trends, but even relative to US peers, a bit better perhaps. Staples are staples, pretty uneventful there, kind of flattish volumes, low single-digit pricing, pretty consistent with what we're seeing sort of globally for staples. The second question, how we work to sort of increase our exposure there. I touched on this a bit earlier, but we've been building up our competency with the European luxury names. We really like that theme. We think the companies are, fairly bulletproof. Right now, we own both Ferrari and Hermes. We tend to think of Ferrari more as a luxury company than an automaker. We also own L'Oreal, which is the world's largest beauty company. But the only caveat there is that while it's a European company, most of its business is done outside of Europe. And we actually own it more as a backdoor bet on China. We own a basket of UK home builders. We think there's definitely a hurdle rate playing out there. Demand is really cratered due to issues of affordability. The margins and returns for that sector are at the lowest level in the last 15 years. Housing starts haven't been this low since the GFC. Seen some bankruptcies. We've seen a number of profit warnings across the sector, which we think is sort of evidence of the magnitude of pain in the industry. That's when we start to get excited. So we see a situation of sort of pent-up demand due to years of underbuilding. And we think that sort of sets the stage for like a good, upcycle when affordability eventually improves. And we already are seeing mortgage rates in the UK come down some. So we really like how things are sort of playing out there.
Thanks for that, Jake. So major economic centers to be desynchronized, right? And we talked about the potential for growth to slow in the US, the potential for growth to accelerate in Europe. And I do want to bring the conversation to China now. Potentially in policy, but we've seen far. Brad, can you talk to us just about some of the most important things that might be playing out in the Chinese economy today?
Yeah, sorry, Jake, you're in and out there, but yeah, for the most part, I feel like I'm a broken record in terms of China. The lack of urgency by Chinese policymakers has been very surprising. There's been little in the way of stimulating the consumer. Seems like most of the fixes are small in gross terms. The most important indicator I look at for the Chinese economy is the one that we have on the screen, which is the 10-year government bond yield, and it just shows anemic growth. The Chinese economy remains in a deflationary environment, and really little in terms of policy to see that shift anytime soon. I've kind of wondered whether this low growth, low inflation world the Western economies faced after the global financial crisis, and even looking at Japan post their real estate bust in the 90s is kind of the roadmap for China, especially given really poor demographics moving forward.
Great. So, Jake, again, I'm going to pose a similar question to you as I did on Europe. Is there anything specifically on the consumer side that's worth pointing out? And then more broadly, maybe you could talk just about some of the Chinese exposure that we have in the portfolios again.
Sure. So, consumer confidence in China remains very depressed, but I would say it's not getting worse. So I view that as a positive. But the broader economy and consumption growth remains pretty challenged, and will likely continue to do so until the property market stabilizes. Some things that stand out to me, delinquencies across all major credit categories have been getting worse. And from what little I've read on it, the banks are turning marginally more cautious on consumer lending. So that's something we're keeping an eye on. At the end of the day, I think it's sort of like a wait and see type of dynamic with the Chinese consumer. A lot of it comes down to policy response. How do the consumers respond to anything that the government rolls out, that sort of a thing. In terms of, what we own or how our exposure looks, we own very few direct Chinese companies. We've been underweight for years, which has been a good thing. We own some Tencent. We've had that for years. We like the various flywheels that sort of powers their platform. My group owns a small position in Anta, which we bought earlier this year. That's a Chinese sportswear company. We like that category. We think the government's placing a pretty strong emphasis on healthy living and physical exercise, which plays directly into Anta's hands. You have Chinese consumers that are becoming more sort of nationalistic. So owning a domestic champion like Anta seems pretty logical. They've been taking share from both Adidas and Nike. Then the last point, with Antas, we think that the apparel category largely immune from regulatory risk, which is something that's kept us out of Chinese names for some time now. Putting aside what's sort of like directly owned in terms of like indirect exposure, certainly we own companies that have decent China exposure. My group, Hermes is probably 40% of the revenues from China. L'Oreal might be closer to 20. Ferrari is not much, less than 10. Then we recently bought a company in the motorcycle value chain that's exposed to China as well. But again, not significant, maybe high teens % of revenue, and shrinking. But yeah, we do have indirect exposure through a number of holdings, but again, I think it's relatively contained. I would say, generally speaking, there's not a big China bet in our portfolio today.
So, guys, we are kind of right up against it with time here, and we got a couple questions come in that I would like to try and answer. So, I think we're going to try and run through this pretty rapid fire. Brad, this first one here is for you. At what point do you think U.S. annual interest costs and national debt level of 38 trillion and growing become a problem for the bond and equity market?
I can speak specifically about fixed income. I think you're seeing some of it filter through now. I mean, obviously, I talked about the long end term premium starting to rise. So I think it's impacting the level of yields currently. I don't think there's like a magic level by which all of a sudden the market revolts. But certainly running 6.5%, 7% deficits when unemployment's at 4% is unsustainable. Haven't within the market, I mean, we haven't had any failed auctions. Auctions have been fine for the most part, in terms of bid to cover. But I do think it probably impacts the ability to react to a crisis. The fiscal capacity is significantly lower if you're going to run 6.5%, 7% deficits with unemployment at 4%. If unemployment goes to 7%, I don't think the fiscal stimulus will be there like it has been in the past.
Yeah, and I mean, quickly on the equity side, it's a cop-out answer, but the answer really is it depends. At a very high level, more fiscal spending tends to mean higher nominal earnings for companies, which tends to be good for equities. I think a lot of it really depends on the response function from bonds, right? If you see yields start to shoot higher, we've seen that that's a headwind to equity performance. You don't know what that could mean for the dollar, and it's too difficult to try and guess with any degree of certainty that would lead you to position your portfolio for it and what it could potentially mean moving forward. Jake, I do have one here that I think you'd be relatively well suited to answer. Given the amount of overseas revenue exposure of the S&P, could a falling dollar benefit the translation effect, or do you find that most constituents hedge away currency risk?
Yeah, good question. I think in the aggregate, about a quarter of S&P revenues come from foreign sales. That being said, it definitely varies by sector. Most of these companies are hedging their translation exposure, which is a relatively simple thing to do with forwards or futures contracts. It's harder to hedge your input costs, and we've seen fundamentals impacted by things like rising cocoa prices or aluminum prices. But translation exposure is relatively straightforward. Companies will book a hedging gain or loss below the EBIT line in their income statement, and sort of all kind of comes out in the wash. The top line can be impacted, but any good analyst worth his or her salt kind of looks through reported growth and focuses on FX neutral growth. We're global investors, so we're used to seeing some pretty wonky things due to FX. I've owned companies exposed to Venezuela, Argentina, and other hyperinflationary economies. And I can tell you that companies generally don't get credit for faster growth if it's due to currency.
Great. I appreciate that, guys. So, we're right up on the hour here, and I want to make sure that we're respectful of everybody's time. If we didn't get to your question, we'll be sure to follow up with you after the presentation. Please continue to reach out with any questions or follow-up that you might have. As a reminder, for your convenience, a recording of this webinar will be emailed to you. And again, feel free to explore the resources tab for additional insights. Jake, Brad, really appreciate you guys taking the time to be here. I like the dynamic and the back and forth between the top down and the bottom up. To our listeners, thank you all for attending today's webinar, and hopefully we see you next time.
Thank you.
Thanks.